Krishna Kumar also joining us this morning. Krishna, good morning. Just to, I'm not sure where to start off. Let's start off with the big news on the Fed rate cut, and what you think this will do for liquidity in the current environment where everything still seems a little uncertain.
I think the Fed has been quite aggressive and cut 50 basis points quite sharply. I think it's been in line with what markets were kind of factoring in. So I think they have tried to backstop the after effects of this virus scare, because once you get to a point where the virus scare dies away, and at that point you would need the economy to kind of bounce back, and that is when probably all this ammunition of liquidity, low rates will come in and help a bit of a V-shaped kind of a recovery into the remaining 8 months of the year. So I think that's what they've tried to do. It helps boost sentiments, help boost some confidence that the central banks are around you. At the same time, I think we do need to see a bit more fiscal measures that will also come through. But over all of this, the most important thing is, the direction in which the virus scare is heading. Unless we see some tapering off of the virus spread globally, things are going to be a bit of, volatile with a downward bias, in spite of what the market, what the Fed and the central banks could do. It would help probably find a bottom somewhere close, but cannot take the economy or the markets up right away.
Absolutely. KK, we were just chatting with our earlier expert as well. And do you think that across the globe we will have a synchronized action from central banks, and there is a big chance that India as well will not be sitting quiet, and there will be an outside policy move perhaps from the central bank, the RBI, which has been quiet and pause mode for the last two policies, may actually come about with a 25 to 50 bips cut as well?
See, different countries, both in the developed world and in the emerging markets, are at different points of the rate cycle, and the kind of space available is different. So, we have to look at it from that context in terms of the tools that they use. Having said that, I think we are having enough ammunition, and we could look at further rate action. Having said that, I think in India, what is more important to consider is the impact of the coronavirus on our growth, which I think at this point is quite minimal. It's not a domestic issue at this point in time. We are having some rub-off probably in terms of how the global growth will be a little slower, and what rub-off it can have on our exports, etc. So beyond that, I think it's not impacting India at this point in time. It's impacting more from capital markets and flows perspective. So I would think that the response could be a lot more measured from the RBI, given that we are still running at a fairly high CPI driven by food inflation. So there could be other tools than just rate cuts that the RBI could consider in terms of front-ending the LTRO, etc., doing more of it rather than just cutting rates, because we could use a lot of it later on.
KK, what is the approach that investors should look at? This is something which is new, which has hit us. We don't know the intensity, or for that matter, the longevity of the effect that COVID-19 is going to have on not just India, but across the world as well. Is this the time to capital protect? Do you start profit taking and keeping the powder dry if you're fully invested, waiting for those opportunities to come? Or do you think it should be just drop that list, the market is giving you great opportunities, start nibbling in already?
Yeah. So I think, if you look at the past, such scenarios, the viruses, other attacks have, passed through, right? So it is an issue of holding on, for a 2 to 4 month period where the uncertainty then settles down. Of course, this virus could be a lot different, but that's an extreme scenario. So our view has been that this will pass over either the virus gets a lot more weaker, or the temperature in the summers put an end to the virus spread, or you get a drug discovery in the near term. So any of these could happen, or like an influenza, the world could start living with corona and have a very low mortality rate. So that's one of those things we live with. So I think any of these possibilities are there, and we would know about it in the next 3 months. So in this period, we would probably see the markets a bit more volatile. However, I think in the long term, investors would be better advised to stay put and not try to time the markets, because it's very difficult to do that. I think use these corrections to add up good quality businesses to the portfolio at better valuations that you're getting at this point in time. And I would urge that investors should increase their equity bets at this point in time over the next 3 months when you could have bad days and market volatility.
Take a tactical call on maybe increasing exposure to mid and small caps at this juncture, or do you think in the recovery, because large caps also have been beaten down, they will recover fast and perhaps much more?
I think given that the growth, in terms of global growth, and also some bit of impact on India from a growth perspective, a small cut of say 0.2, 0.3% on the growth rates, could be there. So from a local perspective, where growth is not very much impacted, but I would think that this provides a big opportunity for India, because you are seeing that, for example, the Indian government is supporting investments in the pharma side with a fund, so that we are more self-sufficient and revive the old units. Similarly, you are seeing also a lot of MNCs look at India more favorably as a second source or a primary source going forward. With all the good work done by the government on corporate taxation and reducing the friction in doing business in the country and reducing cost of logistics and power, etc., we do feel that the FDI into India is going to accelerate in the next 24 months. So on the contrary to where people believe the investment cycle is a little lagged, I would think that this event actually is going to provide a boost to investments in the country and could revive the private sector's interest to invest into capacities driven by also the foreign flows that come into the country from MNCs and FDI.
Okay. Krishna, coming down to sectoral allocation then, any changes you're thinking of making? Would you rebalance in any way given the recent fall?
I think, structurally there are 2-3 things that we continue to play, and I think this doesn't change the long-term bets that we have on the consumer discretionary space, the financial space, and domestic cyclical space like cement, engineering, etc. Tactically, as we just discussed, there are a lot more investments coming through on the specialty chemical side and the pharma API manufacturing side. This is something that is going to be pretty much interesting. We could see a lot of investments here and opportunities for growth. In addition to a lot of capital goods, suppliers into the cycle, I think we would take a fresh look into the beneficiaries on the process manufacturing side, definitely.
Okay, fair enough. And, in terms of, also the pockets which you feel won't be able to completely come out of this, given the impact also possibly on growth, for example, auto, what would be your call there currently?
I think the auto sector has been, in pain for the last 12 to 15 months, and it's because of the liquidity issues driven by the NBFC crisis, and also subsequently by the cost impact because of the BS6 and safety measures that we had to implement. So while the NBFC crisis and the liquidity issue is a lot more resolved, I think there are a lot of financials back on the table in the dealerships at this point in time, though the credit scores are a little bit more harder to pass through. But I think the financing is clearly available back again, and a lot of subvention done by manufacturers also helping. While the BS6 transition is something that we are going through at this point in time, with a good 10% increase in cost on most vehicles, we do expect that the pricing would get a little bit better, and the companies would focus on volumes rather than just margins. And we also believe that the government will also push through a fiscal package through some amount of GST cuts, because the GST cut for the many auto sectors could be helping the pricing scenario to remain more stable and reduce the burden on the consumer. Also, the auto scrappage policy for old vehicles is still work in progress, and we expect it to be rolled out in the next 30 days. And that could also be something that we look forward to. So it could be a binary kind of a play in the near term if these policy measures come through. Otherwise, the auto sector would be something where the first 4-5 months could be a little bit more challenging, and a recovery into the second half is definitely expected.
Just looking at your portfolio allocation, KK, and in your fund, clearly financials has the largest exposure. Next comes consumer discretionary, industrial materials, and then consumer staples, and so on and so forth. Would you use this decline to juggle the allocations in your portfolio at all? Would you ease off from financials if need be?
I think we would not reduce weight on the financials from here, but what we would rather do is to reallocate within the financial space, because you do have the PSU banks, the private banks, and then the NBFCs and the insurers and the capital markets wealth players. So there is a whole host of subsectors which are there. So with the reduction in the funding costs and the liquidity that we are seeing, and we expect more liquidity in India also from RBI over a period of time, we do see that the NBFC sector, which was it was pained over the last 2 years, I think is going to bounce back pretty strongly with sharp cut in cost of funds and sharp increase in liquidity available for them. So that's the space we would rather increase exposure, probably cut some of the banks which are fairly valued. We still avoid PSU banks, and I think between insurance and capital markets wealth, I think we would shift a little away from insurance into capital markets and wealth management companies. So that would be the broader allocation within the financials. But I think financials and consumer discretionary would be two large pillars of long-term growth for us.
The divestment agenda looking a bit shaky, KK, in light of all the recent turmoil in the markets. Is that something that you feel would impact things going down the line if the government's not able to meet that target?
See, I think, portfolio investors like us and, corporate investors who are going to buy these companies are different. While, portfolio investors could have a shorter time frame of 2 to 5 years or 4 years to make wealth creation opportunities, but a corporate who's buying into one of these companies like a BPCL or a Concor or whatever it comes on the plate, I think they are looking at it from holding the asset, creating value over a 50, 100 year and more. It's a full life cycle of the asset, right? So I think people who are strategic investors look at it from a very different lens, and their time horizon and their various assumptions for their cost of capital, etc., and the strategic imperatives are very different. So market conditions will have a very minor impact on what they do to the divestment and the process completely. Valuations, of course, could be a little different from what is there, but I think given the strategic intent of the buyers, I think the valuations finally the government gets would be very good.
Okay, KK, great to have you on the show as always, and thanks for your words of advice for our viewers who are watching the show and worried about the recent market sell-off.
Thank you.
Okay, that's the word coming in from the House of Sundaram Mutual Fund.